Picture this. It is a Tuesday morning. You walk into your local bank branch, the same exact one you have been using for years, to withdraw $8,000 from your savings. Maybe you are finally helping your grandson buy his very first car. Or perhaps you just had a massive storm roll through and you need to pay a local contractor in cash to fix your roof right away. It is your money, so it should be a simple transaction, right? But instead of counting out the bills, the teller pauses. They look at their computer screen, frown, and ask you to wait. Then they call over the branch manager. After a few whispered words, the manager looks at you and flat out refuses to hand over your cash. Just imagine how infuriating that feels. You went to work every single day for 40 years to build your retirement savings. You paid your taxes, you played by the rules, and you did everything right. Now in your golden years, you are standing in a bank lobby feeling like you have to beg for an allowance from your very own account. It is embarrassing, it is stressful, and quite frankly, it is wrong. Hi everyone, I am Kim and welcome back to Kim Smart Finance, where we talk about real-world retirement planning and making sure your money stays exactly where it belongs, under your complete control. If you think this scenario sounds crazy or unlikely, I need you to listen closely. This is not an isolated glitch or a single bad bank teller. What I just described is part of a massive new security net quietly sweeping across major banks and credit unions throughout the United States. Today, I am going to pull back the curtain and show you exactly why banks are suddenly freezing accounts. More importantly, I am going to reveal the simple, straightforward steps you must take right now to prevent getting locked out of your own life savings. Let us get started. So what exactly is going on behind the scenes at your local branch? Over the past few years, major banks and credit unions across the country have quietly rolled out aggressive automated security algorithms. These are invisible, highly sensitive computer systems designed to constantly monitor your checking and savings accounts. But here's the critical detail you need to know. These systems are specifically programmed to strictly scrutinize the transactions of anyone over a certain age, usually those who have turned 60 or 65. You are being watched much more closely by these machines simply because of the year you were born. When this computer system decides one of your withdrawals or transfers looks even slightly unusual, it immediately throws a digital red flag. And once that red flag goes up, the bank now claims the authority to step in and freeze those funds on the spot. In many frustrating cases, they will lock down your entire account for 5 to 15 business days. Think about that. That is up to 3 whole weeks where you cannot touch a single dime of your own money while the bank conducts what they call an internal investigation. During this time, they might freeze your debit card, they might bounce your routine checks, and they will absolutely cut off your access to cash. Now, if you ask the banking executives why they are doing this, they will tell you they are simply trying to protect you. Their stated goal is to stop overseas scammers and local fraudsters from draining the accounts of seniors. And yes, elder financial abuse is a terrible crime that ruins lives. We all want to see the criminals stopped in their tracks. But let us look at the harsh reality of how this is actually playing out for viewers just like you. Every day, ordinary Americans are getting their bank accounts completely locked down for doing perfectly normal things. Good people are having their money frozen because they tried to buy a recreational vehicle for a retirement road trip, or they wrote a large check to cover an unexpected medical bill, or they simply tried to gift some of their own savings to a family member for a wedding. Let us be honest about this. Stopping fraud is absolutely vital. Nobody wants to see a retiree lose their hard-earned nest egg to a scam dot. But treating every single older adult like they are a helpless, easily confused victim is frankly insulting. You have successfully managed your finances your entire adult life. You know exactly how to handle your money. When a bank suddenly cuts off your access to your own funds, it does not just hurt your pride, it causes severe financial stress. How are you supposed to pay your mortgage, buy your groceries, or keep your lights on when your bank decides to lock up your cash for 15 days? It is a heavy-handed approach that leaves honest, hard-working people scrambling to survive. Now, you are probably wondering how banks can legally get away with holding your own money hostage. To understand this, we need to look at the law behind the curtain. But do not worry, I promise we will keep it simple and skip all the confusing legal jargon. It all starts at the federal level with something called the Senior Safe Act. A few years ago, Congress passed this legislation with genuinely good intentions. The government recognized that overseas scammers and local fraudsters were aggressively targeting the life savings of older Americans, and they wanted banks to step in and help stop the bleeding. So, The senior safe gave financial institutions a massive legal shield. It provided banks and credit unions with total immunity from lawsuits as long as they stepped in and reported suspected elder financial exploitation. Basically, the federal government told the banks that if they see something suspicious and report it, they cannot be sued by the customer for getting involved or violating privacy. But the story does not stop in Washington. We have to look at what is happening right now, today, at the state level. As of right now, about half of all United States have enacted specific regulations that are commonly known as hold laws. These state laws take things a huge step further. They actively encourage banks, brokerages, and investment firms to delay or flat out refuse suspicious transactions. These hold laws give the bank the clear legal authority to press pause on your money. The goal is to give adult protective services or local law enforcement enough time to investigate the situation. Depending on where you live, some states allow a hold of 5 business days, while others allow the bank to lock down the transaction for up to 30 days or more. So why are the banks suddenly acting so aggressively? Why are they freezing accounts for a simple roof repair payment? It all comes down to the bank's true motivation, which is avoiding liability at all costs. Banks are absolutely terrified of being held legally responsible. Think about it from the perspective of a bank executive. If a scammer tricks an older customer into wiring them $50,000 and the bank processes that transfer without asking questions, the customer's family might try to sue the bank for negligence. On the flip side, if the bank freezes your account by mistake under these new hold laws, they are completely protected by that legal immunity we just talked about. They cannot be penalized for making an honest mistake while claiming to prevent fraud. Because of this powerful legal safety net, their internal computer systems and their branch managers are essentially tuned to a permanent panic mode. They would much rather freeze your money, cause a massive inconvenience, and ruin your personal plans than risk making a mistake that leaves their institution liable for a devastating financial loss. Let us talk about exactly how your account gets flagged in the first place. When you walk up to the teller window and your transaction is denied, it is very easy to feel angry at the person standing across the counter. But here is the real secret behind the scenes. A human teller is almost never the one deciding to freeze your account. Instead, your personal finances are being watched by an invisible AI watchdog. Major banking institutions now use highly advanced predictive computer algorithms that profile your banking behavior 24 hours a day, 7 days a week. It is a cold, calculating machine, not an understanding human being, that is ultimately making the call. So, what exactly are these sophisticated computers looking for? They are specifically programmed to look for the deviation factor dot. Simply put, they are constantly analyzing your everyday habits to establish a baseline of what is normal for you, and then they aggressively watch for anything that breaks that routine. For example, let us say you live a comfortable, predictable life. You typically spend about $1,200 a month on groceries, standard utilities, maybe a few dinners out, and your regular pharmacy runs. The computer knows this exact pattern perfectly. But then, out of nowhere, you decide to make a sudden wire transfer for $10,000 to help your daughter with a down payment on a new house. To you, it is a joyous family moment. To the algorithm, that sudden $10,000 wire transfer sets off massive digital alarm bells. The machine does not see a proud parent, it only sees a frightening deviation from your established routine. And it instantly locks down the money to prevent what it assumes is a scam. This brings us to a reality that is genuinely uncomfortable to talk about: the undeniable loss of our financial privacy. We all want our hard-earned money to be secure, but in order to run these security algorithms, banks are essentially monitoring every single aspect of your life. They are silently tracking your geographic locations every time you log in. They are logging your everyday spending habits. They are analyzing your entire withdrawal history. They take all of this deeply personal data and feed it into a machine just to decide if you, the rightful owner of the account, are deemed safe enough to make a basic transaction. It is a very strange feeling to realize that a computer program is quietly judging your financial decisions behind the scenes, constantly waiting to hit the pause button on your life the second you do something out of the ordinary. Now that you understand the hidden algorithm watching your account, we need to talk about exactly what sets it off. Remember, this computer program does not understand context. It only understands data. When it sees something out of the ordinary, it assumes the absolute worst. So, what are the most common innocent behaviors that will trigger a massive digital lockdown on your money? There are three everyday actions you need to be incredibly careful about. The first major trigger is sudden large cash withdrawals. Imagine you are working on a major home project and you need to pay a local contractor $5,000 in cash for materials. Or maybe you found a fantastic deal on a gently used camper on Facebook Marketplace. To you, withdrawing this cash makes perfect sense. But to the security system at your bank, a sudden demand for large amounts of cash looks exactly like a classic grandparent scam, where a fraudster calls claiming your grandchild is in jail and needs bail money immediately. It also mimics scenarios where aggressive home repair scammers pressure seniors into handing over cash for driveway sealing or roof repairs. Because the algorithm cannot tell the difference between your honest contractor and a criminal, it simply freezes the funds. The second major trigger involves unusual wire transfers. Let us say you are downsizing to a beautiful little condo and you need to wire money to an escrow company for the closing costs. Or perhaps you are helping your adult child with a down payment on their first home. It is a wonderful, generous moment. However, wire transfers are a favorite tool for international scammers. When the computer at your bank sees a large wire transfer leaving your account, especially if it is not something you do every month, it immediately assumes you are trapped in an offshore romance scam or being targeted by a fake tech support company claiming your computer is infected with a virus. The system panics, assuming the money is about to leave the country forever, and locks down your account to stop it. The third trigger often catches people completely off guard, and that is out-of-state logins. For many of us, retirement means finally having the time to travel. Maybe you are a snowbird heading down to Florida or Arizona for the winter, or you are simply visiting family a few states over for the holidays. While you are sitting in your hotel room, you open your banking app on your phone just to check your balance or pay your credit card bill. Instead of a smooth login, you find your account completely frozen. Why? Because the tracking software noticed you are logging in from a completely different geographic location than your usual home address. The system instantly flags this as potential identity theft or an account takeover, assuming a hacker in another state has stolen your password. In every single one of these scenarios, you are just trying to live your normal life, but the algorithm assumes you are a victim. So, how do we fight back against these oversensitive computer algorithms? Fortunately, there is one powerful, immediate fix that the Financial Industry Regulatory Authority, also known as FINRA, and almost every major United States bank highly recommends. It is called adding a trusted contact to your account. Now, before you shake your head and say, "No," I need to clear up a massive misconception. I hear from so many folks who think adding a name to their bank file means giving up their independence. Please hear me clearly on this. A trusted contact is absolutely not a joint account holder. They are not a power of attorney. By naming someone as your trusted contact, you are not giving them the ability to access your money. They cannot spend a single dime, they cannot make changes to your account, and they cannot even look at your current balance. Your money stays 100% yours, and your financial privacy remains completely intact. So, what exactly do they do? Think of a trusted contact simply as an emergency contact for your finances. Let us go back to that scenario where the computer algorithm suddenly panics because you are trying to withdraw a large amount of cash for a new roof. Without a trusted contact, the bank just freezes your account in complete silence and leaves you stranded. But if you have this shield in place, the system prompts the bank to pick up the phone. They will call the person you designated, maybe your adult daughter, a trusted nephew, or a close lifelong friend. The bank will simply verify that they can reach you, that you are safe, and that no one is secretly pressuring you into making the transaction. Once your contact confirms that you are just taking care of a normal life event, the situation is instantly de-escalated. In most cases, this simple phone call clears the hold immediately. It keeps you firmly in control, ensuring you never get locked out of your own hard-earned money just because a computer made a mistake. Along with naming a trusted contact, there is a very simple habit you should start today. I call it the heads-up rule. Before you go into the branch to make a large cash withdrawal, or before you initiate a major wire transfer online, just pick up the phone and call your local branch manager. Let them know exactly what you are planning to do. Tell them you are buying a used car, helping a grandchild, or paying a contractor. When you do this, the manager can put a specific note directly into your customer file. That simple note acts as an override switch for the security algorithm. It tells the computer that this unusual transaction is expected, legitimate, and authorized by you. This one phone call takes less than 5 minutes, but it can save you weeks of endless headaches. But even with all these precautions, mistakes still happen, computers still glitch, and banks still overreact. That is why you absolutely must implement the two-bank strategy. This is your ultimate financial safety net. I strongly advise every single one of my viewers to open a checking account at a completely different banking institution, perhaps a local credit union, and keep at least 1 to 2 months of basic living expenses tucked away in it. Do not link it to your primary bank. Just let it sit there safely. Why? Because if your main bank ever freezes your funds over a simple misunderstanding, you are not left completely stranded. Having that second account ensures you can still buy your groceries, pay your electric bill, and continue living your life completely uninterrupted while the situation with your primary bank gets sorted out. You work too hard to put all your eggs in one fragile basket. You have worked incredibly hard for decades to build your savings. You have earned your retirement, and you should be in total control of your money every single day. Do not let an automated computer system dictate how you spend it. Now I want to hear from you. Have you or a friend ever had a bank hold up a perfectly normal transaction? Tell me your story in the comments below. Finally, please hit the like button, subscribe to Smart Finance, and share this critical information with anyone who relies on a standard bank account to help protect them.